Good morning and welcome to Stock Market Today. It's Thursday, June 6, 2019. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email. Follow along with this show. Get daily stock ideas for you to consider in your inbox every trading day before the market opens. So U.S. equities finished mostly higher yesterday, with the Russell 2000 as the only major index down on the day. Bond proxies, tech, and consumer staples were the best performers. Very defensive feel to it. REITs and UTs up over 2% yesterday. Energy was the only sector to finish lower, but comm services, consumer discretionary, and financials also lagged. Treasuries were mostly stronger with the curve steepening. The dollar was stronger against the euro and yen. Gold up 40 basis points. WTI crude down another 3.5% on a big U.S. inventory build, pushing crude oil into bear market territory. Outperforming groups, REITs, UTs, tech, staples, add industrials to the list. Underperformers, energy, comm services, discretionary, fins, healthcare, and materials. And as we get to the desk this morning, S&P futures are up 30 basis points after U.S. equities finished higher for a second consecutive day yesterday. So a little bit of a three-day rally going on, if you will. We'll see how today plays out. Asian markets were mixed overnight. China underperformed, losing more than 1%. European markets are moving higher here this morning, and Europe's actually starting to look a little bit interesting to me. I have to dig in a little bit further. Starting to see some potential turn there. Treasuries are firmer across the curve. Dollar is weaker on both the yen and euro crosses. Gold adding on another 50 basis points in WTI crude. Not much of a bounce, but a little bounce. 10 basis points after falling into bear market territory yesterday. Let's dive in on the S&P 500 two-day rally. But there was a very defensive feel. We touched on that already. Support, 2720, then 2650. Resistance, 2850 in the near term. That's that gap here. We're really kind of in a resistance zone right now between, call it 2800 and 2850. But with the close right in the middle of that range, actually, at 2826. So look for 2850 to the upside. If we break through that level, can start to get a little bit more aggressive. All eyes, though, are on the RSI for a shift out of bearish ranges, as I said yesterday, and that remains the case today. That break through 2850, for me, has to coincide with this RSI getting above 60. I have to see some momentum behind the rally. We've had a sharp two-day rally here, but really all we've done is alleviate oversold conditions. Notice yesterday, after even 2 days, after this strong thrust higher, RSI is at 48. Doesn't excite me. Chaikin money flow is neutral. That also doesn't excite me. So I'm watching my indicators closely on breaks to let me know, to kind of inform the decision. Right now, as I've said, we're just kind of in a chop. This is a one-year range. We've gone nowhere. What do you do when the market's going nowhere? Find the relative strength. You should always find the relative strength, but it's in particular, it's so much more important now. With the market shopping around, it's very easy to get yourself caught up chasing the news. Find the relative strength, find the trends that are outperforming, and the ones that have a higher probability of sustaining that outperformance. Market in a minute. Dow, S&P, and NASDAQ move higher for a second day. REITs, utilities add more than 2%. Small caps close lower on the day. Breadth metrics improved in the U.S. and globally this week. Futures point to a higher open today. Power bars. Dow's at even. 6 bulls, 6 bears. S&P 500 strengthened a little bit further yesterday. 110 bullish or very bullish stocks, 77 bearish or very bearish stocks with this 83 basis point move higher. NASDAQ slight underperformer, 19 bulls, 18 bears. There's your small caps down on the day. 385 bulls, 394 bears, back to a bearish skew to the power bar ratio. Bonds down on the day, sending yields higher. Real estate had a monster day, up over 2.25%. According to the Chaikin Power Bar, small cap stocks have become somewhat more bearish than large cap stocks. Major markets are mixed. Our stock of the day today. Remember yesterday we looked at the financials and said they were starting to look interesting? Coincidentally, our algorithm generates a bank stock as our stock of the day today. Lakeland Bank Corp, kind of one of the regional banks and thrifts, closed at 1575, down 82 basis points yesterday. Lakeland LBAI is the ticker symbol, has a very bullish Chaikin power gauge rating, due to very strong earnings performance, very strong price volume activity, positive expert activity, or very positive expert activity, and attractive financial metrics. So the model looks good here. 20 factors, 5 in each of these 4 categories, when combined, give us a very bullish rating. So what do we have? A very bullish stock, strong trend, strong industry group, type of name we want to be looking at on the long side. So what do we do next? We check for the market and model to be in agreement, and they are ever so slightly. I'd like to see this. I like to see this more intensely green. So we were a severe underperformer back in the March timeframe. That trend improved, and now we're an outperformer, but call it an inline performer, really. We want to see this relative strength line get stronger. Now, we've broken a downtrend, and we're now moving sideways. Money flow has shifted from intensely bearish to bullish, coming out of an oversold position. I can't fault you for wanting to own this name if you chose. It wouldn't be a high conviction idea for me. You wouldn't see it as a stock of the day in its current form. You would not see it as a stock of the day in my note to Chaikin Analytics clients. But this does look kind of interesting to me here in the near term. So, for your more aggressive traders, I think you can take a look at it. For your more conservative who are following the process a little bit more closely, I think you can wait. But either way, I think you need to add Lakeland Bancorp to a bullish watch list. Let's look at our sector tracker now, moving to the major sectors over the last 5 days. Remember 2 days ago I said you want to start paying attention to materials? Top of the list, up nearly 6% over the last 5 days. After that, it is defensive. Real estate and utilities. Industrials seeing a bit of a rally here, and the industrials kind of look interesting to me as well. Healthcare, defensive properties playing out, same with staples. Fins, tech, and discretionary also positive over the last 5 days. Energy, you know how I feel there. I'm not going to sit here and pound the table again like I did yesterday, if you might have heard that in the background. But we didn't need oil falling into a bear market to tell us to avoid energy, right? We've been avoiding energy the whole time, and hopefully you have as you've been following along as well. Communications, FANG names coming under pressure, weighing on the communications sector. Our industry in focus today is healthcare services. Over the past 6 months, the healthcare equipment services group has underperformed the S&P 500 by 3%. Its Powerball ratio, which measures future potential, is weak, with more bearish than bullish stocks. You can see it here. 18 bearish or very bearish stocks for only 8 bullish or very bullish stocks. Gets it a rank of number 14 of the 21 subsectors that we track. Some of the indicative names there: Rhythm Tech, IRTC, Tactile Systems, TCMD, and Heska Corp, HSKA, all have very bearish Chaikin power gauge ratings. So as we kind of dig in on that a little bit further, let's look at the ETF. Here's XHE, the Spider S&P Healthcare Equipment ETF. You can see right away it is a neutral Chaikin power gauge ETF rating. So, all right. Not good, not bad, neutral. So we do our work, right? Underperforming the market predominantly since the October-November timeframe and continues to do so. Now, money flow is sending you a mixed signal here. Stock is below a declining long-term trend line, or the fund, rather, is below the declining long-term trend line. So for me, if you're structuring ETF portfolios and getting granular at the industry level, I don't think you need to look at this one. If you're looking for ideas within the healthcare space, I think that there's probably stronger areas of the market. I think you want to think defensive in healthcare. Healthcare's had a nice rebound over the past couple of months, predominantly because of the defensive names. This group is skewed bearishly. Now, there are 8 bullish names in there for you to look at, but for me, I look elsewhere. I want the relative strength. We don't have it here in healthcare equipment. We might get it one day. The intensity is dampening of late, so we'll keep an eye on that, but it doesn't excite me. Trending names now, S&P 500 gainers and losers. On the gainer side of the board, Campbell Soup, beat and raise. Sends the stock higher by 10%. Salesforce.com, positive billings growth. Investors like what they heard there. Send the stock higher by 5%. Brown-Forman, BF.B. EPS beat, although sales missed. It was enough to send the stock higher by about 4.8%, although I will note that some of the analysts were questioning the quality of the beat. MSCI, no real news that I could see. Stock higher by 4.3%. Same with Under Armour, 4.29%. On the loser side of the board, XEC, down 5.38%. This name's been volatile. Oxy, oil, energy, down 4.5%. Halliburton, energy, oil services names, hit a 52-week low. Remember what I said? We didn't need oil going to a bear market to tell us to avoid energy. Halliburton, 52-week low. National Oil Well Varco, NOV, another energy name, 52-week low. Norwegian Cruise Line comes under pressure, down 3.5%. Some commentary about us potentially stopping cruises from going to Cuba, weighing on Norwegian Cruise Line yesterday. So let's dig in now. Bond proxies led the charge yesterday. Here's the XLU, Utilities ETF. Remember when I said to watch the 57 level as long as we hold above there? Well, we did. And now we're moving higher. Above the 50-day moving average, solidly above the upward sloping 200-day moving average, and now on the verge of breaking to 52-week highs. Notice that during this slight consolidation here, RSI never became oversold. Right? Contrast that with the S&P 500, right, which can't even get above 50 for its RSI. Slight pullback here, holds in bullish ranges, higher low, shift to bullish ranges. Bond proxies are continuing to do well. Add to that the relative performance. Bottom of the chart there, you can see XLU relative to the SPY, and you can see broken this downtrend, and we're starting to outperform once again. They're not sexy. They're boring. I don't care. Relative strength is important. Leadership is important. Look for the relative strength. We've been saying for a while that in a slowing growth environment, you want to own defensive yield plays as well as secular growth stocks, and that remains the case. Could have just as easily put this chart of real estate up here, but we looked at it recently, so we look at utilities here today. Consumer staples beginning to outperform, another defensive play, right? XLP, pullback holds support in the 55-56 area, now retakes the rising 50-day moving average, above the 200-day moving average. Notice that on the pullback, never became oversold. And now the RSI is back above 50 and moving back towards bullish ranges. Solid support in here, and now outperforming on a relative basis. Consumer staples was one of the market leading sectors yesterday. Defensive. That's what I said when I said the market had a very defensive feel to it yesterday. REITs and UTs up 2%. Consumer staples, number 4 best performing sector in the S&P 500 yesterday. Taking a look at breadth metrics, they are improving. And that's kind of, they're kind of trading with the market. What I'm looking for in my breadth metrics are two things, confirmation and divergence. Confirmation is good, tells us everything's okay. Divergence tells us to sit up and take notice. Now, I look at a lot of different breadth metrics in my note. Don't have room to really highlight them all here in one show. But what I do look at is the advanced decline line, which continues to track trading in the index. No divergence yet. Moving up and down with the S&P 500, so not telling me much. I also look at the percentage of stocks above their 200-day moving average, what we're looking at here. We're back above 60, and that's compelling. 60 is good. Held support, as did the S&P 500. So no real divergence yet. We look for the divergences tell us to sit up and take notice. Some of the others that I look at, percentage of stocks above their 50-day, percentage of stocks above their 200-day, and I also I track 33 country ETFs and keep track of how many of them are above or below their respective 200-day moving averages, because I think it makes sense to pay attention to the markets on a global basis. Finally, we're highlighting Tyson Foods as a bullish idea today. Comes to us from Consumer Staples. Very bullish stock. Outperforming the market, becomes oversold with bullish money flow. Holding above a rising long-term trend line, pulled back to the lower volatility band around $75 and is now moving higher. I think as long as the stock is above the 75-76 area, you can feel comfortable owning Tyson. A leading stock in what is becoming a leading sector of the market, becomes oversold with bullish money flow and has a very bullish rating. Folks, that is the setup that we look for day in and day out. Take a look at Tyson on the long side. That's it. Head over to chaikinanalytics.com/survival-guide to sign up for my weekly note to give you everything you need to survive these markets. See you here tomorrow.